Navigating the investment landscape, exploring the main types of investment vehicles. In the vast and diverse realm of finance, investors are presented with a myriad of options to deploy their capital. These investment vehicles serve as the conduits through which individuals can participate in the financial markets, each offering a unique set of features, risk profiles, and potential returns. To traverse this expansive landscape, it is imperative to understand the main types of investment vehicles available and the distinct characteristics that define them. Equities, the cornerstone of ownership. Equities, commonly known as stocks, represent ownership in a company. When investors buy shares of a company's stock, they become shareholders, entitled to a portion of the company's profits and, in some cases, voting rights at shareholder meetings. Equities are renowned for their potential for capital appreciation, driven by factors such as corporate earnings, market trends, and overall economic conditions. However, they also entail higher volatility compared to some other investment vehicles, making them suitable for those with a longer investment horizon and a tolerance for market fluctuations. Fixed income securities, the bedrock of stability. Fixed income securities, including bonds and treasury securities, are debt instruments that pay periodic interest and return the principal at maturity. Bonds are issued by governments, municipalities, and corporations to raise capital. Treasury securities, backed by the U.S. government, are considered among the safest investments. Fixed income securities provide a reliable income stream, making them attractive to investors seeking stability and predictable returns. The risk associated with these investments is primarily tied to interest rate fluctuations and the creditworthiness of the issuer. Mutual funds, diversification made accessible. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, mutual funds offer investors access to a broad array of assets, mitigating risk through diversification. Investors buy shares of the mutual fund, and the value of these shares is determined by the performance of the underlying assets. Mutual funds are suitable for those seeking diversification without the need for hands-on portfolio management. Exchange-traded funds, ETFs, a modern investment solution. Exchange-traded funds, ETFs, share similarities with mutual funds but trade on stock exchanges like individual stocks. ETFs offer a cost-effective way to gain exposure to various asset classes, including stocks, bonds, and commodities. With lower expense ratios compared to some mutual funds and the flexibility to be bought and sold throughout the trading day. ETFs have gained popularity among investors looking for efficiency and diversification. Real estate investment trusts, REITs, building wealth through real assets. Real estate investment trusts, REITs, provide a pathway for investors to participate in real estate without directly owning property. REITs own and manage income-generating real estate, such as apartment buildings, office spaces, or shopping centers. Investors can buy shares of publicly traded REITs, receiving dividends derived from the rental income and capital appreciation of the underlying real estate. REITs offer a unique blend of regular income and the potential for long-term capital growth. Certificates of deposit, CDs, safeguarding capital with fixed returns. Certificates of deposit, CDs, are time deposits offered by banks with fixed interest rates and maturity dates. Investors deposit a specific amount of money for a predetermined period, ranging from a few months to several years. CDs are considered low-risk investments, and the interest rates are typically higher than standard savings accounts. However, liquidity is limited, as early withdrawal may incur penalties. Options in futures. Navigating financial derivatives. Options in futures are financial derivatives that derive their value from an underlying asset, such as stocks, commodities, or indices. Options provide the buyer the right, but not the obligation, to buy or sell the underlying asset at a predetermined price within a specified timeframe. Futures contracts, on the other hand, obligate the buyer and seller to transact the underlying asset at a predetermined price on a future date. Options in futures can be used for hedging, speculation, or enhancing portfolio returns, but they involve a higher level of complexity and risk. Precious metals. Safe havens in turbulent times. Investors seeking refuge from economic uncertainties often turn to precious metals such as gold and silver. These commodities have served as stores of value throughout history and are considered safe haven assets. Investors can gain exposure to precious metals through physical ownership, futures contracts, or exchange-traded funds, ETFs, that track the performance of these commodities. Cryptocurrencies, the digital frontier. In recent years, cryptocurrencies like Bitcoin and Ethereum have emerged as a novel form of investment. Operating on blockchain technology, cryptocurrencies offer decentralization, security, and the potential for substantial returns. However, their volatility and regulatory uncertainties make them a high-risk, high-reward investment. Investors should approach cryptocurrency investments with caution and a thorough understanding of the associated risks. Conclusion. The world of investments is a vast and dynamic landscape, replete with a diverse array of vehicles catering to the preferences and risk tolerances of investors. Equities offer ownership stakes and growth potential, fixed income securities provide stability and income, and mutual funds and ETFs facilitate diversification with professional management. Real estate, CDs, options, futures, precious metals, and cryptocurrencies add further dimensions to the investment universe. By comprehending the distinct characteristics of each investment vehicle, investors can craft well-rounded portfolios that align with their financial goals and risk appetites. Navigating the complex terrain of finance with confidence and informed decision-making.